Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, we're going to discuss gold price booming, a government shutdown. We'll also take a look at no tax on car loan interest as well. We'll head on over to the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. Yeah, I had a good weekend, which included the golf tournament that you participated in. Went really well. So, yeah, no complaints, and you know, kind of nice when you have a project like that you've been working on for months in the rear view mirror, right? You can shift to other things.
Yeah, it was a wonderful time. Not only was I able to meet some of the new Plan Solutions staff, Carter, good to catch up with him in person, and also so many of the just amazing folks that turned on out. And it was really, in addition to just getting that time with yourself and my son and our other golfing partner there, just a beautiful day for people to come together and really, contribute to a good cause. We continue to lose too many folks to cancer, so any dent that was made, it's always it's just a beautiful experience. So thanks again to you and all the staff there at Plan Solutions for doing that.
Oh, well, thank you. Yeah, and we lucked out with the weather. You know, it was showing 40% chance of rain earlier in the week, so it ended up being a perfect day for golf, which was great.
Yes, sir. It was. All right, let's dive right in. Let's start with the gold price booming. The price of gold has made headlines recently. Matter of fact, we were talking about this offline about this fact. I mean, my goodness, price per troy ounce exceeding $4,000 recently. What do you think has created the buzz around gold?
Yeah, I think there's a number of things, you know, and gold has an interesting history. Some of it may be kind of a cautionary tale, right? I mean, at one point, U.S. was on a gold standard, so the dollar was pegged to gold, which meant, you know, gold was pegged at $30 an ounce or $35 an ounce, and didn't really deviate from there. But in the 70s, when we were taken off of the gold standard, that was the last time you saw gold prices really surge. They got as high as $850 an ounce in 1980. But then they dropped to as little as $250 an ounce and stayed there for several decades, right? So historically, when you've looked at gold and looked at that type of price performance, it looked pretty poor. You don't usually see something with that type of volatility, and there's not many investments that you could hold for a couple decades and really, you know, make nothing even off of a low. So, you know, are we seeing a repeat of that, right? What's causing this price movement? And I don't think it's any one thing. There's a number of different ways to look at it and try to explain it. One of the theories is what they call the debasement trade. So debasement is basically when countries, you know, make their currency less valuable by printing or borrowing large amounts through deficit spending. Mm-hmm. And so as you have more and more dollars, you know, anything that has a kind of a finite or a limited supply, like gold, should become more valuable in dollar terms. It's not as much that, you know, that item is going up in value as the dollar is going down in value to some extent. And a lot of people are looking at the price increase in gold, also some other assets such as Bitcoin, and saying, oh, that's all part of this debasement trade. And that's why we're seeing these assets go up, which may be part of it. But, you know, that doesn't completely make sense, because if investors were really worried about the debasement of the currency, you probably would see that mostly reflected in the bond market, right? And that's one of the most competitive liquid markets in the world. So you'd expect to see things priced in there more quickly. And of course, if the big concern was that, you know, there's a larger and larger supply of dollars and that they're worth less and less, you'd typically see that with investors demanding higher interest rates. But if anything, we've seen the opposite of the last few years with interest rates coming down.
So why in a period of debasement would bonds be what investors would want to turn to?
Right, exactly. They wouldn't, which is what doesn't make sense, right? If
Okay.
it truly is a debasement trade, we would see people leaving bonds, and therefore interest rates would have to go up to entice people, to actually lend. So that's not really coming together. Another explanation is that gold prices can be a good diversifier for U.S. stock holdings,
Mm,
and with stock prices going up, maybe people are adding more and more gold because they're trying to hedge a larger and larger stock portfolio over time. And that can make sense given some of the historical correlations. Typically when the economy goes into a recession and you have tough times, people run to things like gold as what they think of as a safe alternative, although it hasn't always been the case. And that's a time period where U.S. stocks would struggle. But what we're seeing right now is we're seeing both stocks and gold go up in price, right? So we're not seeing that lack of correlation or non-correlation that you would expect for it to be a good diversifier, which could be if enough people are thinking that way, that it actually could have the opposite effect going forward. And what I mean by that is, let's say stock prices do go down. Well, if they're using gold as a diversifier, they would then be selling gold to buy stocks,
mm.
right? To buy the dip. Well, if stock prices are going down and people are selling gold to buy the dip, you could have a situation where they're not moving in kind of that expected pattern where gold prices are going up right at the time that stock prices are down, so you can sell and take profits on gold to buy stocks. We could see a higher correlation between those two assets.
Have we, history-wise, had any situation where that's been the case?
Yeah, there have been periods where, I mean, the Great Recession, you saw gold prices start to move up, right? When stock prices were down. We talked about when gold peaked in the 1980s. Well, the 80s and 90s were two of the best decades for the US stock market in history with great returns. And meanwhile, gold went from $850 an ounce down to 250. So, the idea that maybe people are selling gold and, putting more of their money into assets like stocks and vice versa, where gold really went up was, in the 70s, which was a rough decade for the stock market. So we have seen this non-correlation in the past, not as much recently. And with the correlation of both going up right now, it makes you really question if it will provide that same diversification going forward.
Right. Well, how are global factors playing into this? Central banks and so on. We've been in. There's been various wars happening around the globe. How is that playing a piece in this?
Yeah, given that the two first explanations that are out there don't necessarily make a lot of sense, right? They don't completely come together. I think the biggest one is the behavior of global central banks,
Mm,
and that really started, the beginning of the war in Ukraine. The U.S. government primarily responded by implementing financial sanctions against Russia, and one of the things they did was basically ban Russia from the U.S. run system that allowed foreign countries to settle their trade, balance of trade. And I think that caused a lot of countries that think, well, maybe they'll be next, right? What happens if they're the target of U.S. sanctions? They started looking for alternatives, including the BRICS, which started with Brazil, Russia, India, China, and has expanded to a lot of other countries. They've even talked about setting up like their own kind of BRICS currency. This is not a currency that you would trade like if you were traveling or something like that. It's just a currency that would be used to settle balance of payments. And one of the discussions that is that it would be backed by gold.
hmm.
So whereas that used to be U.S. dollars and gave the dollar a really strong position, it appears that maybe it's losing out to gold in some of these discussions and how countries will settle those balance of trade payments, and also as a result what they will want to hold in reserve. Obviously you want to have sufficient assets to settle those payments. In the past it would be countries holding a lot of U.S. dollars. Now they're shifting more and more of those dollars into gold.
Interesting. Okay. You've talked about the mania aspect of investing before, but let's get a refresh on it and maybe how it really plays into this.
Yeah, that's the other part, right? Gold might be going up just because gold's been going up, and everybody's talking about it. And when people hear, people talking about it, then they want to pile on, right? I mean, we've seen we saw that with U.S. internet stocks in the late 1990s with a big run up, and then they, were down 85% from the top to the bottom. We saw Chinese stocks in the early 2000s when they were kind of opening their market, and they were down 90% from the peak. Of course, U.S. real estate prices, right, that led to the global financial crisis from 2002 to 2006. It went down 50% or more in some areas, right? But people were piling into housing because that was the thing that everybody was talking about. So, that's the other possibility, that we're just seeing such a big move in gold prices because it's taking on some of those characteristics of one of those manias. Only time will tell. You never really know that you're in a mania for sure, but you really can't be sure until after.
Right. Yeah, it's an interesting scenario. And when I was reading this, it just made me think of that old adage, what goes up must come down. So it'll be interesting to follow and see how this plays out.
Yeah, or at least it reverts to the mean, right? If you have kind of a historical, reasonable rate of return, prices can get way higher, way lower than that, but they often come back to that geometric mean of what is a reasonable growth rate. With gold, that's kind of scary because historically that rate of return has been about the rate of inflation, as opposed to bonds that can pay a little more, or stocks or real estate, which historically have had higher average annual rates of return.
All right. Well, let's jump on over to government shutdown. The U.S. government shutdown is now entering its third week. Both parties clearly believe that the shutdown will benefit them in the minds of voters. But what are we seeing come to fruition here? I recently spoke with a gentleman who's an air traffic controller, and I got to tell you, he was feeling the stress, as was his coworkers.
Yeah, yeah. These issues are tough. Whenever you see Washington, where both parties think that they're winning on an issue, which obviously both can't win on an issue, but if they think that they will, nothing gets done, right? Because they both rather keep it in the headlines and keep having the argument rather than solve it. And so that does make it kind of worrisome that this shutdown could really drag on. And as we start to look at the implications, how it can negatively impact the economy. I mean, the first that we've talked about is data collection, right? The U.S. government does a lot of data collection for economic and financial indicators. And we've already, seen jobs reports, inflation reports, economic growth reports. I mean, they're all basically on hold until the government reopens. So that makes it very challenging for economists, financial analysts, business leaders. How do you make informed decisions when you're somewhat flying blind because the visibility is significantly reduced, given that you basically only have the private data sources to rely on.
Yeah, well, and I mean, the thing that maybe people aren't picking up on too is when the shutdown hits, it doesn't just, it affects all federal employees across the board, and those paychecks don't continue to come in, and many of people are being asked to continue to work despite potentially not receiving any income.
Yeah, or maybe they're not working, but they still have bills to pay, right?
Right.
I mean, that's going to be the next big challenge will be the missed paychecks. Current federal law requires that employees, continue working, or some employees continue working, such as air traffic control, as you mentioned, obviously the military being a big one, even if the government's not issuing paychecks. Now, once the shutdown is over, they're supposed to receive back pay. But that loss of current income, if it continues for a long enough time period, could definitely affect consumer spending. So the nearest deadline we have is was actually yesterday, October 15th, when the military was scheduled to be paid. Will there be a workaround? Is it legal? That's all up for debate. So in terms of what's happening there, but after that, you have the end of the month when other federal employees are due to be paid. And so if those paychecks aren't issued, It obviously could have a negative impact on consumer spending because if people aren't getting the money, right, they're probably going to have to use savings or borrow or something just to cover the necessities, but unlikely to be splurging. And that naturally, will hit some economies, some areas harder than others based on federal employment. But economists estimate it could subtract up to 1% off the U.S. economic growth rate. And even if there is back pay, you may not get all of that back, right? People, if they wanted to go out to dinner this week, they're not going to go out to dinner twice next week if they suddenly get paid, right? So that may just be lost consumption. That could be a dead weight drag on the third quarter or fourth quarter economic growth numbers.
Yeah, well, and I would think as far as if we look at the individual too, maybe it's situations like you said, having to take that loan from someone, borrow some money, or spend on credit cards, and maybe then by the time they do get paid, not being able to pay that credit card in full, and then accruing debt, and so on and so forth. So it's definitely a mounting situation.
Yeah, or if nothing else, the interest that they have to pay, right? Which is
Right.
then reduced consumption. Yeah.
Right. All right. Well, let's jump on to no tax on car loan interest, effective for the 2025 through 2028 tax years. Taxpayers may be able to deduct up to 10,000 in interest paid on a loan used to purchase a qualified vehicle. I mean, that's pretty good news, but obviously, every time we read the first sentence, there's always some constraints that come to that.
Yeah, so this is another one of those little additions to the one big beautiful bill, right? We've been covering a lot of them, most of them not real big, not and aren't going to have a real big impact on the average person. But it is good for people to be aware of it because every little bit does add up. So yeah, you have to go back to the 80s for the last time that any interest on car loans was deductible.
Mm.
Of course, back then the highest marginal rates were up in the 70s, right? So you had a very high income tax rate, but you had many, 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 many deductions. Now we have fewer deductions, but lower tax rates. So it kind of balances out. But this is a return of an old idea. So people who do borrow, to buy a car, which is not great right now with where interest rates are at, but maybe you just need to do it. They could benefit from this, but people do need to be aware that it does phase out as the modified adjusted gross income goes up. So for single filers, once you're over 100,000, joint filers over 200,000 of modified adjusted gross income, you're going to start to lose the benefit. The loan must also have been originated after December 31st, 2024. So only loans that you took out this year would be deductible. And then, you just want to check and make sure that, that you're eligible, that, it has to be a new car, right? I mean, that it's an eligible car, but assuming that the people do meet all of those criteria, they may be able to get a little bit of tax savings from writing off that car loan interest. So definitely something they don't want to forget if it will create a tax benefit.
Yeah, it's similar to how we were talking about with EVs. There are those constraints, like you said, must be for personal use, not for business use, must meet weight requirements, and must have undergone final assembly in the United States. So there's always these different factors, which, of course, like you said, we don't ever want to ignore them, but you want to be aware of it as well. So anything else you want to add to no tax on car loan interest before we move to the bulletin board?
Yeah, you bring up a great point. If this is part of the decision-making process for someone, they should definitely talk to their tax preparer and make sure they're going to qualify. With the EV credit going away September 15th, I've already talked to a number of clients who ran out and bought an EV thinking, oh, I'll get that credit, and they didn't qualify, or the car didn't meet the requirements, or their income was too high, right? Because they had some type of event this year that made their income higher than normal, and they kind of had forgot about that and didn't realize, oh yeah, they're going to be completely phased out. So, in some cases they took the $7,500 credit at the dealership, and I had to be the bearer of bad news that come tax time, they're going to have to pay that $7,500 back because they didn't qualify. So
Right.
yeah, make sure you qualify if that is a big part of your decision-making process.
Yes, sir. All right, let's jump on over to the Plan Solutions Incorporated office bulletin board. We touched on it a little bit at the top of the podcast, but just a beautiful experience at the Harlan D. Wood and Debbie Dravenga Memorial Cancer Charity Golf Tournament this last weekend.
Yeah, it was great. There was a lot of good things going on. I thought the professional long driver on hole 15, right? It's always amazing to see somebody hit a golf ball near 400 yards. It's like your eye can't even follow it. It's moving so fast. And I got a lot of people were very happy with instead of doing the sit down dinner, we did heavy appetizers. It kind of flowed a little better, and a lot of I think they did a great job with the appetizers. In terms of variety and quality. So yeah, Country Club staff did a great job. The Plan Solutions staff did a really good job working hard to make sure everything was set up and flowed well. A little bit light. We didn't quite fill up in terms of the number of teams that played. But we still raised a decent amount, just shy of $11,000 that'll go to cancer charities out of, all the different costs and things. And that brings our cumulative total to almost 190,000 over the years that we've been doing this tournament. So, not a huge amount, kind of a drop in the bucket, but, a little, a lot of drops add up over time, right? And maybe could make a difference. So, really appreciate everyone who worked hard to make it happen. Really appreciate everyone who participated, and can't wait till next year.
Yes, sir. Absolutely. Looking forward to it as well. Well, we thank you for listening to the Plan Solutions Incorporated podcast. Please hit that follow button on Apple Podcast or Spotify if it's your first time and you haven't done so already. And please share with someone else that you think will get value out of the podcast. And if you'd like to follow along to a visual form of the podcast, you can go to our YouTube channel, youtube.com/@plansolutions, and find it there and just hit that subscribe button. And if you need to and have not yet subscribed to the Personal Financial Review, the written content we discuss here on the podcast, just send Katie an email to get subscribed today. Her email address is katie@plansolutions.com.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.